I got rates falling, markets falling, economy's falling. You're going to tell me overweight, 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 overweight? I just read down the whole list of your coverage.
So let me...
Nice to see you, by the way.
Nice seeing you.
Always a pleasure.
Now get out!
Hey, man, I'm just saying what everybody watching is saying right now.
Look, and what we're hearing from investors is it's late cycle. Who wants to own banks late cycle? But I want to give some perspective here. With all the concerns related to the banks, higher deposit rates, margins, not much loan growth, not much capital markets growth, flatter yield curve, how much do you think earnings estimates have been revised lower? Take a guess.
0. A little bit.
They're up 7%. Earnings estimates for this year for the large banks are up 7% for this year, and they're actually
That was right, 0.
They're actually up higher next year too. So
Give me credit.
banks might not be making the numbers the way everyone thought. The top line growth has fallen short, but banks are getting it done through better efficiency, still good credit quality, return of capital, more annuity-like progress at the banks.
I got you. Citi, good example of Citi, overweight, $100, right? Buying back more stock than anybody in this space, right? We're close to it. If they're not the top dog, they're right there, right?
Well, let's talk about Citigroup then.
Is that right? They are. They buy back a tremendous amount of stock.
Absolutely.
Right? All the catalysts that you said, plus they're buying back their own stock.
Sentiment is clearly negative. Ultimately, though, Citi stock and bank stocks will follow earnings. Earnings estimates are higher. Even through a recession, we think banks can gain share against a bunch of non-bank competitors. But let's talk about Citigroup. So Bank of America and JP Morgan are performing just fine. We expect record efficiency at both companies over the next few years. Revenue should grow faster than expenses, even if revenues don't grow as quickly. Credit quality, we expect that to go higher by 2/3 over the next 4 years. It's in the numbers. But let's talk about Citigroup here, because the chief financial officer gave a presentation 2 days ago and said that Citi is going to miss its efficiency target by 9 basis points. We don't think that's okay. It's not okay for Citi to once again miss its efficiency target, whether by 9 basis points, 1 basis point, or a millionth of a basis point. And
you're going to battle with these guys again?
That equates to $70 million of additional expenses. And they said that they're going to fall short in a nonchalant way. Well, we're going to fall a bit short. Well, how can they fall a bit short? So what we're saying that Citigroup should do, they should find $70 million of expense savings before the end of the year, and maybe that means reducing compensation, reducing the number of Ubers that they use, reducing travel, reducing holiday parties, whatever it takes to find $70 million of additional savings.
You've turned around on this stock. You loved it.
Yeah.
Now you're picking a fight with Corbat again?
Mike Corbat is an A-plus person, but he needs to increase the intensity. This was the CFO who gave the presentation 2 days ago saying they're going to fall short. We'd like to see the CEO override the CFO and say, you know what, we're going to find $70 million of additional savings. And by the way, if you take the bonuses of the top 5 executives at Citigroup last year, guess how much that equals? 70 million. So you can.
I'm 2 for 2.
You can reduce the bonus of the top 5 executives, or you can reduce the bonus of the top 25 executives by 20%.
Why do you think they would do that when there's no consequence whatsoever to them year after year missing these types of targets? What all of a sudden, is there a shareholder in the mix here who's powerful enough?
Well,
I like what you're saying. I just don't think it's going to happen.
I will say,
like talking to the shoulder.
That's great.
No, I'm beside myself.
You me like Derrick Henry? Is that what's going on?
No, I can't believe that this is happening at Citigroup of all companies. And the investor feedback since we published our note has been overwhelmingly in favor of what we have to say. So you do have, I assume
Stock's done nothing for 5 years. The same guy's still there. What's the difference?
Well, we think shareholders are speaking up a little bit more often. You're right.
Jim, you own Citi. Pete, you own Citi.
Yeah.
Everybody owns.
Cooperman yesterday talked about it, right?
We can pick on Citi. We can pick on Citi.
It's all the banks. They're shareholders of Vanguard. They don't answer to anyone.
I don't want to pick on Citi. I don't want to even discuss Citi anymore. Let's go broad. He's got overweight ratings on all the stocks.
Let's go broad. Whether it's Citi or the other large banks, the concern is who wants to own banks? We might go in a recession. And to that we say, we're already close to recession-like prices. You could have another 20% down if you have a recession. We could also have 40 to 50% upside if you don't. So the reward-to-risk ratio looks good. Here's the point. In a slowdown, even in a recession, book value increases for Citi and the other large banks. That's the key. And you can slice that a million different ways, and we have high conviction on that. So if your price-to-book ratio is almost close to recession level and book value goes up even in a recession, then banks are a buy.
Let me ask you this, okay? Dow's at session lows. Market's not doing well. The market continues to be upset like this. These stocks aren't going to do anything, right?
Well, that's the sentiment call, and we recognize there's
But that's the realistic call, isn't it?
No, not really. Not if you have earnings growing, like 8 to 10% next year and another 8 to 10% the year after that. You have cost control, which is going to be better than it's ever been before in the banking industry. You have credit quality. Again, we have losses going up 2/3 over the next 4 years. It's in the numbers. And you have capital return. These are the most resilient balance sheets you've had in decades. So if you have a recession, banks have a lot of dry powder to actually gain share, to re-intermediate from the capital markets if you have a recession. Oh, and by the way, no one said we're actually having a recession.
Let me just get in here, because I agree with everything you're saying about the positives here, but here's the facts. A lot of these companies, whether it's Citi, Goldman Sachs, Bank of America, they never got the mid-cycle price-to-book premium that they deserved. So now we're in this situation where you never got the good side, you're getting the bad side. I mean, look, Scott's right on the sentiment. I mean, the sentiment is so terrible here. So my question to you is, what turns these around? Everything you said is true. It's not mattering. So what turns these things around?
So in terms of potential catalysts, our interest rate strategist at our securities firm expects the yield curve to actually steepen. I mean, you have deficits going up and up, so the supply at the 10-year is going to be a lot higher. And he also thinks that the Fed will be buying more short term, so the demand for 10-year, so less demand, more supply would ultimately mean a 10-year going higher. So a steeper yield curve could be a catalyst, but ultimately it's earnings coming in through thick and thin consistency that you haven't seen.
It just hasn't mattered for years.
It will. Right. I mean, the stock market, it took the stock market in the late 90s a few years to catch up to the fundamentals of the banks. We think this period is similar. So
we got you.
And by the way, the dividend yields, the cash back yield, if you throw in the buybacks, I mean, these are some very nice yields at a time when the 10-year is back below 3%.
True sentiment of how you feel about the banks is represented by the fact that you didn't bring a prop.
Oh, I wore a red tie to reflect the red in the bank stocks this week.
All right, there you go. There you go. All right, I knew you wouldn't leave us hanging on that.
Well
Mike
done.
Mayo, Wells Fargo, senior banking analyst, joining us there.